Today, I'm diving into debt to income ratios, or DTI, and how they play into the VA loan. This topic can be a bit confusing, so my goal is to give you all the facts and break it down clearly to help you understand how it all works. What is a debt to income ratio? The definition of a debt to income ratio, or DTI, is a measurement used to see how much of your monthly income goes towards your debts. There's two parts of it. The front end ratio is going to be your projected housing payment divided by your gross income, so your income before taxes and deductions. The second part is your back end DTI, and this includes all monthly debts that are reported on your credit report, such as credit cards, car loans, and includes things like child support, plus your projected housing payment to give an overall ratio of what your income is. Your DTI helps lenders to understand your financial obligations compared to your income. But for VA loans, it's not the sole deciding factor. It's just one piece of the puzzle. VA loans are unique because, unlike any other program, they use an additional calculation called residual income. This looks at how much money you have left after paying all of your debts, including your housing payment. It's designed to ensure that you have enough day-to-day living expenses for things like food, utilities, and transportation. Residual income takes into factor things like family size, location, taxes, and average maintenance costs onto your home. Even if your DTI is high, your strong residual income can mean you're still in a good position to qualify for a VA loan. While most borrowers pass the residual income with no problem, there are a few situations that it can be tight. For example, larger families, because the calculation adjusts for household size, people with non-taxable income sources such as VA disability and Social Security. And the reason for that is because we're allowed to gross up your Social Security and disability because it's a non-taxable income. We want to make sure that we're giving you the full benefit of all the income you can use. But in the residual calculation, we're not including that gross up factor. Also, larger homes where higher maintenance costs play a factor. For example, there may be a large family with a debt to income ratio of 35%, and they have non-taxable income. This may cause an issue with their residual income. On the other hand, someone with a 60% DTI could pass residual income if their income is high enough to offset their debts. While it is possible to get an approval for a VA loan with a debt to income ratio over 50%, maybe even over 75%, it's not always a good idea. A higher DTI rate means that you have less room for unexpected expenses, which can put you in a tough spot financially. This is why budgeting is so important when considering your debt to income ratio and overall financial picture. In rare cases, high DTIs can make sense. For example, if there's significant income in the household that isn't being included in your qualifications for the loan. For example, someone that has a spouse that's not on the loan, or maybe they have a new job that a new company they just started where they haven't had a 2-year history at that, but they have, or a second job that they don't have a 2-year history. However, those incomes can't be used on their income qualification or the residual income, but it isn't a significant factor, compensating factor for why someone could have such a high DTI. These cases are exceptions and not the rule, so it's critical to approach high DTIs with caution. Debt to income ratios are an important part of the VA loan, but they're not the only factor. Residual income plays a significant role in determining whether you qualify. Residual income calculations to ensure that you have enough money left over for daily living expenses and paying your debts and housing costs. While VA loans are flexible, it's essential for you to understand how your DTI and residual income impact your approval and long-term financial stability. VA loans are an incredible benefit for you as the veterans and offer flexibility and opportunities that other loans just don't touch. Understanding how DTI and residual income work together will help you use this benefit wisely. Thank you for watching, and I hope this clarifies the role of DTI and residual income in the VA loan.